Hello and welcome to Pro Trader Strategies Market Commentary for Wednesday, April the 8th. I'm Eric Wilkinson, and yes, you very well may recognize me as the Wolfman from mainstream media, where I've talked about everything from economic and geopolitical environments and how that impacts the overall markets with my market analysis. Well, I do that same thing in these daily market commentaries, but I layer on top of it some option strategies that I use to implement into my portfolio to increase that overall yield. So hopefully you can learn from that. Take your market assumptions, apply these different rules that I have for these option strategies to better increase that yield in your overall portfolio. But please remember, past performance of any trading system or methodology is not necessarily indicative of future results. All right, with that out of the way, let's get it on with that economic data. Across the pond, not a whole lot to see there, but here in the United States, we got our crude oil inventories. That was a build of 15.2 million barrels, expected to be a build of 9.8 million barrels. Now, that is the biggest build ever. Okay, that is the largest single build that we've ever seen. We're also seeing that we had some builds in distillates that was about 476,000. Crude oil, like I said, biggest build ever there at 15.1 million barrels. Cushing, biggest build ever as well. Gasoline, second biggest build ever at 10 million barrels, okay? Also, we're seeing, I've talked about this, demand just cratering. Some of the biggest drops we've ever seen in demand for gasoline and production demand. So rig counts really low. They're not bringing those guys online. They're actually shutting some of those down. You know, if we're talking about this whole OPEC meeting that's supposed to happen tomorrow with Russia and Saudi Arabia, which looks like it's kind of starting to crater as well, we are somewhat limiting our production because we can't afford to produce at these levels. So we are cutting back, it looks like, on our production, not because we want to, but because we have to. So I don't think that that's going to make up for this build because, like I said, nobody's driving. Everybody's at home. That means the demand for gasoline is just tanking. I also saw that our CO2 emissions are cratering as well, which is a good thing because everybody's working at home, nobody's driving, but manufacturing, being the biggest driver of those CO2 numbers, are not really working. So that's where we're seeing the demand for the distillates really crater. All right, so that all culminating in crude oil being up by $1. That doesn't make sense. We did see a bit of a push higher on the API numbers last night, but like I said, always fade those API numbers with those types of moves, really, because API is voluntary and the DOE is mandatory. So that is something that is mandated by the government. The API is, they can say whatever they want, but they have to give the real numbers to the DOE. And then we also saw consumer confidence or consumer comfort numbers, which is a little bit of a behind the scenes number. It's not really a headline number that a lot of people see. We saw those crater as well. So a lot of things should be causing these numbers. We talked about yesterday with the way that the charts were setting up that maybe we were seeing a topping pattern going on, and I'll break that down when we get into the equity charts. But we're not really seeing that. We're actually seeing quite a different scenario where the markets, last I just checked, were very near the highs. So let's get into the overall economic data. We already did the economic data. Let's get into the charts. That's more fun anyway. We already mentioned crude oil up for whatever reason on massive builds to the point where we are going to be seeing them struggle with storing all of this oil. Okay, so I don't know where they're going to start storing it. They might start paying you guys to take barrels and start parking them in your backyard. So just so you know, one crude oil contract, by the way, is 1,000 barrels at 55 gallons a barrel. So if you got a spot to store 1,000 barrels, you can take one contract and take delivery on that. All right. We've got gold futures up by about $5.50 again today. It's trying to make that move back into the 1700s. I've talked about this. The real resistance is right at that 1700 mark. It is a psychological level. We don't have a mark or a line of demarcation for that with the Fibonacci's or anything else, but it is going to be a psychological number that is going to be a overhead resistance at this point. Going forward. Then, why is my pin showing up? All right, bonds coming off as we're seeing that strength in the equities. And we talked about this yesterday. That line at 183 is going to be a very difficult row to hoe to get above. All right, that is a line of demarcation that is going to be difficult to trade above, because that's where we start seeing long-term interest rates like the bonds start going in below 1%. So that is a hard nut to crack, especially when you're thinking way forward, inflationary aspects, all of those things going in there. If we start believing that inflation is going to be an issue, then interest rates should start to climb. And with the amount of money that the Fed is kicking out there right now, that is a real thing that we might have to look at. On the flip side of that, it is a race to debase. Every country is printing as much money as they can right now, so that kind of all levels itself out in a sense. Another thing to talk about today is they're releasing the FOMC minutes, and that actually could be happening at any moment here. I don't think that it's actually scheduled for a specific time, but it is about the two emergency meetings that we had back in March. So everybody's going to be trying to peel through that just to see what their thought process was going through all of this. All right. Dow Jones Industrial Average up 560 points right now on the day. You can see very near the highs of the day. Something to note, remember we talked about this, the way that the charts were setting up yesterday was with basically a hangman doji before the end of the day. So if I show the extended hours trading, it ended up switching it out to being a spinning top doji, which is still a very bearish sign. Now, when we're talking about those two different types of chart patterns with the candlesticks, then we can talk about what we were seeing yesterday when I took out the overnight trading session. We had something that looked like that, well above a green candle, which is usually a very bearish sign. Well, by the end of the day, you can see this is the type of chart pattern we got set up as well. So this is usually signaling a top right here. This is a very top pattern type scenario. Obviously this would be a better, that would really signal a confirmation of a top. Well, we got the same situation where we still have that green candle over here where we got that move there, but then we've got a really extended wick that you're not going to be able to see on your chart, but ends up kind of like that, with a little bit of a wick at the bottom, creating that spinning top area. Now, obviously, if we got a market move like this, that would be a confirmation, but we're not really seeing that happen there, right? We're seeing this market move higher, so we didn't get that confirmation as of yet. Everything could change. The market could slam down. If the Dow Jones was down 500 points on the day, that would create that type of pattern where it would look more kind of like that, right? So that would again then be that whole topping pattern. So as of right now, nothing really to make of this. It hasn't been confirmed. It looks like we're trying to continue to the upside at this point with the market's move. But as we saw yesterday, at the end of the day, the markets just cratered. Almost right after I got off the daily market commentary, we saw those markets sell off. So I'm still under the whole thing. You sell those days where there are rips and you buy back in on those dips for an intraday or on a trading day-by-day trading system. All right, we've got the Nasdaq up almost 140 plus points, back above 81.65, and that is lining up with my Fibonacci there. I think that what's going to be a little bit more readily looked at this point is that 200-day moving average. Getting above that is going to cause this 50-day moving average to move away, all right? Because anytime we've got a pattern where we have that 200-day moving like this, right? So that's what we're seeing right now. And then we've got the 50-day moving average coming back down to it. If it crosses over, that is a very bearish signal. We don't have that happening right now. It's staying above it. So, you know, what they want to see happen is a situation where the market has the 200-day moving like this, and then we get the 50-day moving average peeling up and away from it. That would still give a bearish feel to the overall market. So a move above that 200-day moving average might be a little bit more important at this point than the move above my Fibonacci lines there. All right, so let's move over to the E-mini S&Ps. We've got them up about 62 points on the day, trying to get above this 52-week low, as you can see right there. That's why I have that chart set up there still for the long term. I know a lot of people like to adjust these Fibonacci's every single time there's a new high and low, but to me, the way that the Fibonacci's have lined up very nicely with my market profile, which I believe is a little bit more important. We got the market profile over here, and you can see that we have Fibonacci's very closely lining up with my different Fibonacci's. And to me, because that is the psychological aspect of the markets there, and then even the value area high, to me, those are more important, especially when we can get those Fibonacci's to line up quite nicely with the market profile. So that's exactly why I'm leaving those in there at this point. I could probably throw in a market profile, or Fibonacci down there, in and around that, add another layer. But I haven't done that at this point because I'm keeping my eye on the fact that I believe that these markets are going to migrate back towards those points of controls that we've already established. All right, let's move over to the E-mini S&Ps on the daily chart. We were talking yesterday, and you can see probably right around in this area is when I was doing the daily market commentary. We were getting that push to the upside. We did print that intraday high, and then as soon as I published this thing, we had an unabated sell-off, like into the end of the day, to get those lows printed from the overnight for the most part. You know, a couple ticks off of it maybe, but just a free fall. It just felt like the markets were falling out of bed going into the end of the day. So today we're starting to see a little bit more bullish sentiment coming into the markets. Why? Because a lot of these coronavirus cases are starting to slow down. It looks like the curve is being flattened. We're also seeing, and I'm going to butcher the malaria drug name if I try to pronounce it right now off the top of my head without reading it. But anyway, I talked to a medical device manufacturer yesterday. He talks to a lot of doctors, obviously, and behind the scenes, I think a lot of these doctors are seeing that malaria drug, hydrochloroxidone or something like that, whatever it is. I gave it a shot. Anyway, they're saying that they're seeing better than a 75% effective rate for people that get this drug early. So if you are at a point where you are in respiratory distress, no, it's too late for that. But if you are in the early signs where you're starting to feel a little sick, and you can get tested if there's testing for it, and they realize that you have corona, then they can administer this drug, and they're seeing a very good effective rate on that. So people getting better much quicker if they get those drugs administered early on. So a lot of those things I think are what are happening, and people coming off the ventilators now. So we're seeing that as well. And all of those things being equal, we're starting to see it push higher. Now it's really going to be the big question right now, let's say, the big question in everybody's mind is the FOMC minutes, all right? So the minutes are coming out anytime soon. That could change anything going forward. We'll see how that affects the overall charts for the rest of the day on what they were thinking and how they are going to be mechanical. All right, so a couple of trades that I want to talk about here is my SBUX trade. If you guys remember, I got put this stock. I had sold the March 70 puts in there. Well, I own those now because we, in March, obviously, were trading below that area at expiration. So I have caught that bounce. We're trading right now at around 71. Well, I was staying mechanical. I covered those SBUX calls by selling the April 70 calls, which expire in like 9 days. So a wash. I bought and sold at the same place, right? Got that stock put to me at 70, so I'm long at 70. I sold those calls at 70, and now I am out at 70, if we stay above there, obviously, right now. But in the meantime, what we want to talk about, you might be saying, Wolfman, come on, now you could have made more money on that. Well, right now, if I just had bought SBUX, if you just went out there and bought SBUX at 70 and got run over there, and now you sold it out at 70 because you put in an order. You were like, I don't want this. I'm just going to put in a limit order at 70. Well, you got in and out at 70. All right, you were out. Well, for me, the same thing might have happened. I sold some puts at 70. I collected 44 cents on that. All right, so I get to keep that collection of money. It lowered my overall basis on that, so I'm long at 70 minus the 44, so I'm long at $70.56, right? So I had lowered my overall cost basis on that by doing it with options, and then I went in there and sold covered calls, where I sold those April 60 calls for 45 cents. Well, at this point, those April 45 call, or those April 70 calls are worth a lot more because they're in the money. But once this gets called away from me, that stock gets called away from me, I still get to keep those credits. So yes, I may have done the same thing as a trader using straight stock, getting in and out at 70. Well, I lowered my overall cost basis by almost 90 cents there. So I get to keep those collections. I made money, all right, on that trade. Yes, I did have to take some heat on it, but SBUX I didn't think was going to go out of business, and that's why I stayed with that trade. So those are ways we stayed mechanical. I'm getting out of that trade. I'd rather get out of some of these long stocks anyway, and be able to allocate some more money elsewhere, to be quite honest. And then also we are looking at Microsoft is another one where I had got the stock put to me, right? I still believe in this stock. I actually didn't want this stock to necessarily get called away from me. More, I'd rather see some of my airline stock get called away from me, or even SBUX. I don't care about SBUX. But Microsoft, I think, is going to do very well in this environment. I've talked about people building out these home offices because more and more people are going to be working from home. I think that is going to drive demand, and they're going to actually see some good results from all of that. So with that being said, if you guys remember, I had done these in the March as well. So I had gone in and sold the March 160 puts in there. So I got to put that stock to me. I had done a lot of things where I had sold the 85, sold the March 60 calls against it. And it looks like I am going to have those called away from me as well. So I am long Microsoft at 160. I did this a little bit more, a bigger tranche than what I did with the SBUX, but still, I covered it equally with my short calls that I had done in there. And had originally sold so I did the March 60 calls, had that stock put to me. I had thrown in there selling some 126 puts in the Microsoft that I collected money on. All of these things staying mechanical with that. It started out as selling the 160 puts for 86 cents. I had then sold a couple of more 160 puts for $1.29, and then I decided, that was all in the same day where I saw that big move happen on the 21st. So we talked about this actually already, but on the 21st, where is the 21st? 23rd. Oh, jump in March. Am I reading that right? Oh, sorry, this was in February. February 21st. There was no March 21st. So February 21st. This was the day we got that big drop. Right afterwards. So I got the big drop right there, sold the 160 puts, and as the day was dropping, I added some more to it. Not necessarily the best trading strategy, but I had originally sold the March 160 puts for 86 cents, added a little bit more when I saw them at 129. And then we got a big drop, as you can see. Then we got the big drop happening in there, and then on, what day was it? The 12th of March, I sold the 126 puts. So on this day right here, that's where we sold the 126 puts, trying to, again, now I'm looking to dollar cost average. I know I'm going to get put those stock at 160. So sold in some 126 puts for another $2.10. Those I was able to get out of for a nice little profit. And then all in all, sold the April 185 calls to cover that trade in there. The 185 calls I bought back for about 15 cents. As we got another little bit of a drop in there a few days later, covered those for a nice profit. And then, so I basically rolled out of those April 185 calls into the April 160 calls, bought back the 185 for 16 cents, got a total collection of $1.33. So the 160 calls I sold for $1.15-ish off the top of my head. So now I've covered that entire trade where I sold the 160 puts. I did that twice. Sold the 126 calls, 126 puts. Those never got put to me. I got to keep that collection, got out of those. And then all in all, I can't do the math in my head right now, but you can see I lowered my overall cost basis quite dramatically. Right now, yeah, it's trading 165. What did I do? I'm basically long at 160, short the 160 calls. It looks like I'm going to get that stuff called away from me. But in the meantime, you know that I can say that I collected on my roll from 185 to 160. I got $1.34 on the 185 calls. I sold those for 55 cents, right? So I added in that roll in there. So I'm looking at $1.90 and sold the 126 puts, $2.10. So I'm at $4. And then the two calls that I collected for those puts, selling those 160 puts, that twice basically, that was a collection of another $2. So I got a total of $6 on that. All right. So again, if I had bought Microsoft at $1 or $160, got out of it when it got back up to 160 just because I didn't want to deal with it, I am still ahead of the game than if I were still holding on to it. If I bought it at 160, now it's up $5. Yes, I had to stay mechanical with it, but that's what we do as traders. I lowered my overall cost basis dramatically. All right. And yes, it's getting called away from me now, most likely. But at the end of the day, I was able to trade around this, stay mechanical with it, and lower that overall cost basis so I can sleep at night. And that's what I try to explain to you guys, is that's what we need to do as traders and investors. Lower your overall cost basis. Rather than just going out and buying stock and selling stock, this is a great way to be able to sleep at night. So, without further ado, and we need to talk about this. This is all educational purposes. These are things that I'm doing. I'm not trying to influence you guys to do the same thing as me. I don't like the herd mentality, and these are important things to keep in mind as well. So, please take a moment to go over this disclaimer as it talks about, yes, you can lose a lot of money by investing. Had I done it differently, or had you done it differently, you could have lost a lot of money, and those specific trades. So I'm not a financial advisor or a tax advisor. Please consult those guys before you move on with that. I'm just here to talk about how we trade options and how we can overall increase that yield in our portfolio moving forward. All right, sorry it was a little bit long today in the tooth, but I wanted to go over all of those trades to keep you guys informed, win, lose, or draw, how we're working through that and how it's working out for us. All right, so if you can't take that, take it easy.